us for this month's market update. I'm here today with KC Lowe from Frontier Advisors, Capital Markets and Asset Allocation team. Hi there, KC.
Where?
Well, certainly in the news as we're sitting here today is the collapse of Silicon Valley Bank. Step us through that and particularly the repercussions for investors here in Australia.
Yes, so that's the big headline right now. So Silicon Valley Bank is a big US bank. They're the 16th largest US bank. In terms of assets, they have around 200 billions in assets, so quite a large bank. And this is the second largest US bank collapse in US history. So
Considerable event.
Yes, significant impacts there. But maybe to start off with, just to give you background, the unique features with Silicon Valley Bank is that most of the deposit is concentrated in startup companies and also venture capital firms. So it's quite a concentrated deposit base, but also that they invested this money into long-term bonds, which is, it's not atypical of banks to do that. They usually borrow short in terms of deposit money and then invest in long-term assets like bonds. But unique to Silicon Valley Bank is that they have a very concentrated deposit base in terms of just startup firms and venture capital, and they invested heavily into long-term bonds, so very concentrated investment portfolio as well. So the problem arose when interest rates started to increase last year. So the Fed started to increase interest rates, but also other central banks. And as these interest rates increase quite materially, the value of Silicon Valley Bank's long-term investments started to fall. On top of that, as the economy started to slow, a lot of these startup companies were burning through the cash, so they were withdrawing the deposits as well to run the business too. So then it was a double hit of deposits were shrinking, and also they were losing heavily in terms of their long-term investment portfolio, which forced Silicon Valley Bank to need to raise more capital. This spooked a lot of the depositors, and it started a bank run, which led to the collapse of the bank. So that's sort of the background on it and the problem with it. But in terms of broader implication, there are concerns around contagion risk and systemic risk around US banks and the banking system. So far, the regulators have stepped in, and it seems like it has provided pretty good comfort to the market, but it's something to watch and it's ongoing. The other implication is on future interest rate expectations. So what the market has taken from this is that as interest rates have increased so much, we're starting to see these strains and stress in the economy. So the banking collapse is one example. So they've revised down the interest rate expectations. So it'll be interesting to see at the Federal Reserve's next meeting in late March, how they're balanced between increasing this interest rate and causing more financial strain and stress in the system versus trying to bring inflation back down under control.
Interest rates certainly seem to be at the heart of a lot of the things that we're talking about these days, KC. And here in Australia, the Reserve Bank have once again lifted the cash rate.
That's right. So they've increased the cash rate by another 0.25%. It's 3.6% now. The main takeaway though is that yes, the Reserve Bank of Australia have said that most likely they'll need to continue to hike interest rates, but the Governor, Philip Lowe, have also said that they are probably closer to taking a pause now because they have increased interest rates so much. They want to see how that flows through to the real economy. So in some ways, that's a positive in terms of they're closer to taking a pause. That has flowed through to the Australian dollar. So the Australian dollar was trading closer to 72 cents in January. It's fallen to 66 cents now.
Yes.
So that's one of the factors driving that. But in addition to that, the Reserve Bank made this decision before the Silicon Valley Bank collapsed in the US. So it'll be interesting to see how the Reserve Bank take on this new information at the next meeting. The market seems to have adjusted expectations on the back of it. So for Australia's cash rate, just 2 weeks ago, the market was expecting the cash rate to peak at around 4.4%. Today, it's still quite volatile, but right now, the market is expecting the Reserve Bank of Australia to actually start to cut interest rates around the middle of this year. So big changes there.
Lots of moving parts and moving quickly. Thanks for that assessment, KC. And thanks for watching this month's Market Update.